Thanks so much for tuning in to BQ Prime. Let me start by wishing all of you and your families a very, very happy and prosperous Diwali. And I'd like to think that through this show, we'll be contributing to some of that prosperity in the new year, because Cracker Stocks is meant to give you the best ideas to invest in the medium term to long term. My guests are going to give you their ideas, and we'll discuss the fundamentals so that you're on the same page when you decide to press that buy button. Let me introduce my guest today. We've got Rahul Arora, who's the Chief Executive Officer of Nirmal Bank Institutional Equities, Amisha Vora, who is a co-owner and Joint Managing Director of Prabhudas Lilladher, as well as Sudip Bandyopadhyay, who is a Group Chairman of Inditrade Capital. Thank you so much, all of you, for joining in, and a happy Diwali to you, your teams, and your families. According to legend, Diwali also marks the return of Lord Ram to Ayodhya, and the city, according to legend, lit up and served as a beacon for Lord Ram to come home. We're seeing dark clouds gather across the world. The question is, a lot of people have said that India can be that beacon. The economy can remain resilient. The market can remain resilient. I want to understand from you what you think about this. So I will start with Sudip, and then I'll go to Rahul, and then we'll get Amisha's view on all of this. But Sudip, let's start with you.
Well, Alex, wish all your viewers a very, very happy and prosperous Diwali and New Year. Yes, there are a lot of dark clouds hovering in the horizon. The geopolitical situation, as far as the world is concerned, is extremely sensitive. There is no solution in sight as far as Russia-Ukraine war is concerned. There are significant pressures in the economy of Europe. US is battling inflation, and one is not sure about how the economy is going to look up. But as far as India is concerned, I think the biggest question is the oil prices, as well as domestic inflation. Now, there are two components. We know imported inflation as well as domestic inflation. Both are looking bad, and RBI has been continuously increasing interest rates. Now, this definitely is going to have an impact on growth, and we are all worried. Of course, now translating back to capital markets, yes, if there is a slowdown in growth, interest rates keeps going up. At some point of time, the markets also will start reacting negatively. We still have been at a beacon of outperformance, and the global markets are looking at us, but there are a lot of worries. Now, I like to bring one factor, which is in addition to what all we know and we talk about all the time. That's what's happening as far as Chinese markets are concerned, Chinese capital markets are concerned, Chinese economy is concerned, and overall Chinese governance is concerned. Now, why it is relevant is because globally, emerging market funds have raised trillions of dollars for investing in emerging markets, and a large chunk of that, everybody's guess, between 70 to 80% was deployed till recently in China. Now, with what's happening in China, the way the Chinese markets have kind of collapsed, the way the governance structures and the rules have changed, investors are really, really worried as to how the future capital market in China will work. And we have been seeing a lot of money coming out or trying to come out of China. Now, we believe that is some part of it, I'm not saying significant here, which may be the case, but at least some part of it will have to flow into India. Whether it will flow in next month, 6 months down the line, one is not sure. But this is the silver lining, we believe, in the dark clouds we are seeing. And this will propel India ahead.
Interesting point. Rahul, what do you think about that? Because, see, while there is some element of hope and there is some element of, as Sudip just pointed out, a silver lining, from the global context looking in, there are challenges as well.
So again, Alex, I'll just echo Sudip's sentiments and wish you and your entire team and your families a very happy Diwali. So in some strange ways, Lord Ram has returned back to India, hasn't he? Over the last 2 months, FI money has come back to India. And that's something that we were weaning for and asking for. And I think that supplemented the domestic liquidity very well. But I think, Alex, without getting too much into the silver linings or the dark clouds that are hovering above us. I think the fact that the Nifty's moved from 7,500 at the peak of the pandemic to about 18,000 and change at the top end, currently hovering in and around. I think money making is going to be very tough next year, Alex. I think we need to call a spade a spade. It's been relatively easy to outperform the indices so far, but I think the point that Sudip made about crude is well taken, and Europe's getting into a very, very severe winter, and the kind of challenges they're facing with power. I think there's probably another leg up for commodity prices in November, December. I wouldn't be surprised if crude heads back to 105, 110, and you see other prices also inch up, and inflation still continues to be an issue in the early part of the next calendar year. So I think it's going to be very difficult to make money. I'm not saying that the opportunities will not present themselves, but the kind of ease with which money has been made over the last 2 years, it incrementally may not be that positive or that easy to make it from here on. Because I think, as sell-side analysts, when we, one of the things that we have done is we've actually rolled over to FY25 just to justify buy calls. And if I was not a sell-side analyst, I would think that was too early to do. And the reason that's been done is because on a 1 year forward, you're not able to justify stocks. You will not, it doesn't matter whether it's my brokerage or a Morgan Stanley or anybody else. It's going to be very difficult to justify stocks on a 1 year forward basis. So that itself tells you that, things are probably a little ahead of themselves where they should be right now. And given where inflation is, given where the economies are primed to be in the better part of next year, which is a slowdown, if not a recession in most developed markets, I think people need to be a little more disciplined in the way they approach investing, because it's not going to be all that easy to make money.
Fair point. And pragmatism is, in fact, something that will hold investors in good stead. Amisha, what's your view? I know it's tough to comment after so many things have already been spoken about, but do you anticipate, as Rahul says, that it's going to be difficult to make money, that a few important picks will be the most important thing to take into the new year?
So Diwali wishes to you and all the viewers. And of course, I've heard and I acknowledge the concerns, pros and cons of each of the previous speakers. But I feel that, when the COVID hit world and India, economy was in dire state. There was just no business and markets kept on moving. So now could be the time when our economy is doing comparatively extremely well. After, I guess, almost a gap of 6 to 7 years, that when I'm speaking to corporates across the length and breadth of sectors, I have not come across a corporate saying that their business is not good at the moment, despite all the inflation pressures. So now is the time when economy may do very well, and at best, market could be range bound. The good part of the economy and the strength may not allow it to go down quite a lot, but the global fears and the reducing liquidity, both from global markets as also India, because we try to support our currency and suck out a bit of the liquidity, will keep a cap on the upside. But net, I believe both markets will give positive returns from here if one takes Diwali to Diwali, which is a very bold view, but yes, I do believe that. And I believe that while stock picking will be important, the choice from across the sectors will be very good, because we'll not see order books flowing the way it is from a very, very long time.
It's very interesting that you say that, and it lays the context perfectly for this chat, because each of you has picked 2 stocks, and I think we have quite a diverse set to speak about. I will ask each of you to speak about one stock, and then we'll go to the second recommendation. I will start with you, Rahul, because I think your first pick is what I thought was the most interesting, because PVR is the pick that you have first. And a lot of people have talked about the underperformance of PVR in recent times, because people are just not going out and watching movies. But there is expectation that things will improve, consolidation in the space, the merger, of course, and everything else. But why do you say that PVR is your top pick?
So before that, Alex, there is only one lady on the show, and it's the time of Diwali. So they said, Lakshmi ghar pe aati hai. So Amisha is saying Diwali to Diwali will be positive. So I would say aapke muh ki shakar, and I hope it pans out as such. But yeah, Alex, I'll tell you the one thing that has changed for the multiplex industry. And, I've had the privilege of actually setting up a business channel in India, along with one of the biggest producers of Bollywood movies in India, which was Bloomberg UTV at the time. And I saw the way UTV actually changed the way content was approached in Bollywood. And the way content writers were now being paid so much more as opposed to historically, maybe even a decade back. And I think that probably gave us the birth of actors like Irfan Khan, Rajkumar Rao, Ayushmann Khurrana. And I think, if you even go back 5-6 years, Alex, you would find that, it was only Eid, Christmas, Diwali, some of these occasions where the big releases of the Khans or an odd Akshay Kumar movie would be releasing. I think the good part is that the predictability of content has gone up so much more. It's become so much more multi-language. I mean, South as an industry has just, gone through the roof. And the fact that those movies are getting dubbed in different languages across the country and doing well in those languages. And just the fact that even in Bollywood, you have a lot more 50 and 100 crore movies that have come through. I do understand the last 5-6 months have been a lull. But that's because you had a lot of these movies that were either in post-production just before COVID or had to be rushed through production in COVID so that they meet their deadlines. A lot of this inventory was relatively old. But I think come this Diwali, where you have an Ayushmann movie, later this year, you have a Ranveer Singh and Alia Bhatt movie. I think the entire situation will revive. I think most of these multiplexes have worked their cost structures really well in the pandemic. I think the thing to realize is that the advertisers are also coming back. That's about a 95% gross margin business. F&B, which is something that we all complain and crib about with the prices of popcorn and Coke, that enjoys about a 77-78% gross margin business. So I think once the footfalls come back, the operating leverage in this business is very, very strong. And, as you rightly pointed out, this is essentially going to be a monopoly business once the merger goes through. And given that someone like Netflix is cutting back its India content by almost 60%, it tells you that there is definitely a space for someone like a PVR. So I don't think valuations are that exorbitant. I think these companies are now going to operate structurally at maybe 18-20% kind of ROEs and ROCs. And the fact that content predictability is going to be a little bit more, I'm happy to pay even current price. I wouldn't be surprised if you tide over this interim pain, the stock would probably even return you 40-50% over a certain period of time. This is in some ways a recession-proof industry. I mean, you will probably go in and watch a movie even if things are bad, because where the higher end of the price points are, inflation impacts may not be felt that much. So I think it's a great mid-cap stock to have in your portfolio.
Certainly, and you've highlighted the reasons very well. And so this is, I think, something that you might have to have a little patience with, right, Rahul? But I'm going to go to the second one. And Amisha, this one is also kind of an all-weather pick, I think, apart from when the pandemic hit because people were not traveling. VIP Industries is your pick. But it's not just bags for travel that VIP is focusing on right now. If you talk about Caprese as a business line, and they seem to be focusing more on exports as well. Is that why you picked VIP Industries?
So one, of course, is the entire portfolio and the way they want to focus. But the portfolio itself is aligning a lot with the bigger theme that of consumption, and the consumption which is experiential. People want to experience. And having seen India, I think that trend is just going to become bolder and bolder. Having said that, they, as what you very rightly picked, they are very, very bullish about the bag segment, the Caprese, and then they are relaunching with a huge vigor with the new CEO, with a lineup with Manish Malhotra, and they are very, very focused on that. Even if we have taken just a 30% growth, management is expecting this to be a 5x in 3 years, which is really ambitious. I think apart from that, the important part is that because of the way now things are aligned with China, exports is a huge opportunity. And they are also tripling their franchisee centers across tier 2, tier 3. All this combined with the fact that the cost had been so much elevated currently, and the commodity prices are softening, plus their indigenization is increasing, I think augurs extremely well, both for a 35 and another 25% bottom line growth, zero debt almost, extremely high ROEs upwards of 30%, And so I think it's a very consistent CAGR story with high growth.
Yeah, and interesting. I saw the note that you guys have come out with as well, and it points out that certain changes in terms of subsidy structures in China are allowing for a larger pie to be taken by Indian manufacturers as well. So that's an interesting play. I'll come to you, Sudip, on your first pick, which is a name that everyone knows, Ultratech Cement. But I'm curious about this pick because of the kind of competition that you're going to see. You're seeing consolidation in this industry as well. Does Ultratech Cement continue to command its market share and its leadership position?
Absolutely, Alex. I think let's go back to the from the beginning. I would say that, look, there is no question mark about cement. I think pretty much everybody and everybody is sure that cement is going to do well in the foreseeable future. Forget what they come up in Q2 because it was a monsoon kind of a quarter, but the tailwind is definitely behind cement, and infrastructure build, private capex, public capex, housing for all, everything, road construction, everything requires cement. So, and you can't increase capacity overnight. Yes, the Adanis are taking over Ambuja and ACC, but the capacity can't go up overnight. Yes, they are talking about increasing capacity. Of course, there is these consolidation, or so to say, acquisitions in the pipeline. Everybody is talking about. But remember, these things do take time, and these doesn't change the installed capacity. Acquisitions don't change installed capacity. If you look at installed capacity, Ultratech is way ahead of ACC Ambuja combined as well. They are a very well spread out cement manufacturing units across the country, supplying to pretty much all the markets. And don't forget, they are also in the game of acquisition. So while we are assuming, the new players will go and do the acquisitions, the existing entrenched market leader surely can also do acquisition. Ultratech is also talking about expanding capacity. They already have a significant lead above everybody else. So considering all that, I think to write off Ultratech and to put all your money behind the Ambuja and ACC may not be the right strategy. And somehow we believe that this is one sector where probably we'll see the Asian Paint syndrome play out, which is the industry leader keeps doing better and better and keeps moving leaps and bounds ahead of others. And I think Ultratech has all the ingredients of doing that. Specifically analyzing performance, I think the cost pressures which were there on the industry to an extent is thing of the past. They have taken price hikes. Next couple of years, I think the new capacities are not going to come up in a hurry, and the suppliers will have to a great extent some control over pricing. So with that augurs very well for an industry leader as far as the margins, as far as profitability and business is concerned. So I have no hesitation in recommending Ultratech in an uncertain environment, which I think pretty much all of us, including Rahul, is commenting on that. The things are not very clear. Probably we are a bit more optimistic than what we should be. Under the circumstances, for an investor, I think stock like Ultratech is a good bet.
So interesting picks. The first three picks have already been interesting, considering that you need entertainment irrespective of what time it is or what's happening around you. You need bags because you need to travel, and cement is absolutely important as a backbone of infrastructure in the country, right? I think the next pick, and Rahul, this is your next pick, is something that everybody, or practically everybody that I know, needs in the morning as well, which is coffee and CCL Products. So interestingly, we spoke to CCL Products not too long back, and they talked about a massive capacity expansion that is underway that will culminate, I think, in the next financial year. Is that what is giving you so much positivity or optimism about the stock?
So, Alex, I think the beauty of this company is that I think we had initiated on this company at about 50 or 60 rupees, if I remember correctly, and the price today is about 500 or thereabouts. So, despite being a 10 bagger, it's not even coming to you at 20 times 1 year forward. For a company with a 23-24% kind of return on equity and return on capital employed profile. As you rightly pointed out, it is a market leader. A bulk of the capex is actually, that was put up over the last 7 to 10 years. that actually is coming up in the next 2 years. That itself shows you the kind of efficiencies that they've gotten into the system. And the good part is they're now going into B2C as well through their Continental brand. So one is, I think, they're adding about 85% of their existing capacity over the next 2 years, which is going to be a very big fillip in terms of being a volume driver. They have most of the global companies like Strauss, and at one point they were actually a very big supplier to Nestle as well. Not anymore, but they've got some very, very big international brands across the world in their fold. In fact, recently added one in North America. I'm not sure if the management alluded to that in your conversation with them, but I think the fact that this is a company that has a potential to take its B2C brand to about 500 crores over the next half a decade. The fact that they've been able to show capital efficiency and their capex in such an efficient way, and even despite the fact that half of it is brownfield and half of it will probably be greenfield, it's just it fits right. It's a consumer company, like you said. There are not too many that are doing spray dried, freeze dried, all of it in totality and making a success of it. There have been issues, there was obviously the Russia shipment issue when the war started. There was a bit of a crisis in Vietnam with respect to shipments last year. But this is, these kind of things happen in the running of every business. And I think every kind of fall that this stock gives you is a good opportunity to buy in. So market leader, gaining market share, capital efficiency, 85% of incremental capacity coming on, strong return ratios, very good balance sheet, and good reasonable valuations for a consumer-related stock. I think it's a good brew, I think, to have in your portfolio, I'd say.
Yeah, you said it. In fact, it's the product that they're selling is so ubiquitous as well, and everybody needs coffee. Or practically everybody needs coffee. I say everybody, but we're a nation of chai drinkers as well, right? But I'll go ahead and ask Amisha about her next pick, which has to do with Jubilant Ingrevia, the specialty chemicals player. And it's a space that a lot of people have focused on, Amisha, in the recent past. Specialty chemicals companies emerging from India. It's not like they didn't exist before, but a lot more attention being given to them. Why specifically Jubilant Ingrevia?
First and foremost, I think the chemical sector, as all of us know, is doing very well. It was till now China +1 or competition to China, but the way energy prices are shooting up across the globe, and particularly Europe, where a large part of production, specialized chemical production resides and also gets consumed, I think we have a much longer run ahead for chemical companies. And some of the key ones like Gujarat Fluoro or Naveen or Basel, I think will continue to do well. But we picked Jubilant for a purpose. We thought that, and we understand that, a large part of their business composition is changing for good. From a commodity-driven business within chemical, a good portion is moving to specialty, which is almost 30-31% currently to 60-65% in 2 years' time. And that finally leading to almost a doubling of net profits will also command re-rating. So we thought that this is a story where we get good profit growths plus a potential to re-rate. And that's how we thought that we picked this within the sector.
Certainly. And it's an interesting pick as well. The final pick, and then we'll have a sort of a summation. The final pick, Sudip, is also a household name and something a lot of people are familiar with, is Larsen Toubro. So you've actually picked infra-related stocks. The second one, of course, is Larsen Toubro. If I look at the last 10 years, though, a compounded annual growth rate in the stock price of about 13% in any sense. But do you anticipate that growth is going to be significantly better in the near to medium term?
Absolutely. I think that's one of the reasons why, Alex, I did suggest this. I'll lay out a couple of facts for all of us to hear. I think the first thing, as far as Larsen is concerned, is pretty much the same thing which I talked about Ultratech. There is a tailwind. And the tailwind comes from the construction boom, infrastructure boom, where we all know L&T is an undisputed leader as far as Indian construction infrastructure space is concerned. That's the go-to company for projects, big projects. The second thing is we all know what's happening in the oil prices. We have all our views, but the fact is oil oil is on a boil. And that kind of gives Larsen a big opportunity in West Asia. They have been already in hydrocarbon sector in a big way, but in between, the oil prices came down, their business, hydrocarbon business suffered, and now they are gaining traction once again. The third thing, which never happened in L&T before, and that's the reason of this subpar or sub-average return, was the asset monetization. That was not happening. There was a conglomerate discount, but that has started happening. And we know how things have been moving as far as the technology companies in the L&T fold is concerned. And the fantastic results, to an extent, they have unlocked. It has given fantastic results, though it's still not captured in L&T valuation fully. But more and more asset monetization is happening. And this is, in a way, excellent step, because the company needs to focus on things which they do, rather than these businesses which have no direct linkages or bearing with the core business. So that asset monetization is happening, and that is resulting in improvement in working capital, liquidity, and pretty much everything as far as we see. Last but not the least, a massive amount of digitization is happening as far as their core business, which is the construction infrastructure, and that's going to bring multiplier return as far as efficiency is concerned, which again will translate into profitability and growth. Overall, we believe, I think the time for L&T is coming now. Now, again, I will say whether it's going to happen within couple of months, 6 months, I'm not sure, but definitely at current level, when market is a little bit of wobbly, crisis corrections are being seen, it will be an interesting strategy to pick up L&T. Again, I will repeat the fact that world is volatile, so rather than moving to tier 2, tier 3 stocks, which may promise interesting prospect, but the risk becomes also proportionately high, I would recommend investors stick to large cap, known names, solid management, established business. There is very little chance for you to go wrong when you pick up an Ultratech or a L&T.
Absolutely. And in fact, it's a very complete array of stocks that you've picked, very diverse set of stocks that you've picked, but a few sectors very noticeably absent. Rahul, as well as Sudip and Amisha, we've not mentioned banking at all, or financial names at all, and we've not mentioned IT, but I guess IT is a sign of the times. There will be times, of course, in the near future for us to talk about that in a lot more detail. I think that wraps up today's edition of Cracker Stocks, and they have indeed been an incredible list of Cracker Stocks. So once again, let me wish all of you a very, very happy Diwali. Thank you so much for joining us on BQ Prime.